Good evening.
Good evening too.
Thank you and welcome once again. It has been for a while. We have not been having our classes due to some situations or circumstances, but we can be able to resume from where we left. I remember that we were dealing with we have already tackled the mergers and acquisitions and the portfolio theory and analysis. And I said they are the one of the most important areas which you need to put a lot of effort into. And we are approaching our third topic, which we are hopeful we can push and complete by next week. That is by the end of June. We am hopeful it can happen. And from there, we are going to be remaining with two more key areas, which we'll be able to handle them on July. And we will be able to work harder towards our anticipated or our exams, which they are already approaching. I think around August there. So let me just look on this topic. In my notes, it's topic 1, but under my syllabus on how I have handled it is our topic 3. So the advanced capital budgeting decisions, I remember it's not a new topic. We used to do it under section 3, and we did it as the introduction to capital budgeting decisions. So it means that there was a time you have to face the advanced part of it. So in this case, it refers to the investment decisions of the firm. That is, the decisions on how the firm should invest in the long-term projects so as to maximize the shareholders' wealth, stock the value of the firm. And we are saying such decision may include one, the reason as to why the organization normally do some investments. The organizations or the firms normally does the investments based on the expansion of an existing projects, replacement decisions, right? Undertaking a new project of the product line, then the research and development activities. Through this expansion which the organization is looking at, there is some challenges in which we can be facing. One, we talk about the uncertainty in the expected economic life of the projects. Uncertainty in the expected future cash flows, which are always based on the forecasted values. We're also talking about inadequate information. That is, it is practically impossible to gather all the relevant information about our projects when in advance. Uncertainty in the cost of capital. That is, the firm's WACC is subject to some fundamental assumptions, which they may affect the projects. I remember now when you are dealing with the cost of capital, we discussed about two major areas here. We talked of the WACC and the WMCC, the weighted average cost of capital, and then we have the weighted average marginal cost of capital, WMCC. So there are some of the things which we discussed there when we were doing the financial management. One was that the WSCC was focusing on looking on the existing capital structure of the organizations. Then we had which was using the historical data of the organization. Then we have the WMCC. The WMCC, it is a situation where the organization was finding itself based on the investment into new projects. So that is the differences. The difference is that there must be the WCC, which we have to be looking at. What is the effect of the capital structure of the organization? If, for example, we are looking on the existing capital structure, those things we shall be doing under the advanced financial decisions. Advanced financial decisions is where we are going to be revisiting the cost of capital. It is a very major topic which we did under section 3. Now, let us look at the types, because let us look at the types, right? And when we are looking at the types, when you look on the types, there are different types of the, what is the problem now? One minute, please. So let us look at the types of the capital structure. Not the types of the capital structure, but for the investment projects. Number one, we are looking on the mutually exclusive projects, and these are alternative projects which always compete with one another and cannot be undertaken together. So the selection of one of the mutually exclusive projects automatically will be able to disqualify the others. So in the mutually exclusive, it means that we have once we choose, right? It's just like excluding the aspect of the polygamy. Once you choose one wife, right? You have excluded the others under consideration. I know that that is a case for both gender. We have independent projects, and these are not related in any way. Hence, they call or be undertaken subject to their profitability and availability of cash. So in this case, when you're looking on the independent projects, it means that they can be undertaken, right? We are saying that they are not related in any way. For example, now you can be investing your money in the money market, and also you can be investing in a kiosk, right? They don't relate in any way, but they are going to be, it normally depends with how much the money you have to spearhead your project. So when you look on the complementary or dependent projects, these are the projects which rely on each other for survival, and they must be undertaken together. Now, that is, the selection of one of the complementary projects automatically leads to the selection of the others, e.g., where there is a finished goods of the project become the raw materials for the other, right? I remember now we are looking at the complementary. It means that the raw materials of, not the raw material, but the product of a certain organization is the raw material to another organization. So it means they are dependent, right? The one is normally dependent by the other to produce the raw materials and so on and so forth. Now, let us continue here. We can be able to talk about divisible. We are talking about divisible or indivisible projects, and we are saying divisible projects and are the projects that can be scaled down towards downwards, hence implemented partially, while divisible projects cannot be scaled down, hence can only be undertaken if 100% of the initial outflow cost is available. That is the thing that we're going to be revisiting when you are doing the capital rationing. The capital rationing is we complete this topic. Now, when you look on the divisible projects, when we talk about the scaling down of the projects, it means that an examiner normally has this question. I think it is somewhere in 2021, where the examiner was asking what is the NPV when the projects are divisible and indivisible. So in that case, it means that if a project is divisible, right? If it is divisible, it means that you can invest partially, because you have to be ranking your profits, ranking your project using the profitability index. Now, in that case, you have to be investing best all the money or the requirement of the initial outlay to the best performing projects of yours, right? And then you continue all that up to you exhaust the capital which you have. So that is the aspect of the divisibility. And you can be able to invest, regardless whether the remaining capital which you have, you can invest the part of that capital to a certain project. But indivisible, it means if you cannot be able to meet the target, if you cannot be able to meet the aspect of the initial outlay, then it is so hard for you to accomplish the mission of investing with the different types of the projects. So if you cannot be able to meet the initial outlay, then you can't be able to invest in such projects. What are some of the benefits of the capital budgeting? One, we are saying they involve significant amount of cash flow, hence can lead to heavy losses in case of failure. Secondly, we are saying that such decisions are highly reversible, can only be reversed at a substantial losses. The decision normally affect all the decisions affect the department of the company, which may influence the operations of the entire firm negatively. It may affect the morale of those employees. Are those the benefits? Let me see. There might be some challenges, I think. It may affect the morale of all the employees of the firm in case of failure. In the case of failure, let me look at the arrangements of the notes. Let me see. The importance of benefits. I think those are some of the challenges, because we are saying it may affect the overall risk of the firm due to high cash flows involved in its implementation in case of failure. I think those are some of the challenges experienced. Characteristics of a good investment appraisal techniques. We are saying that it must use discounted cash flows on not accounting profits. And accounting profits can easily be manipulated if they include non-cash items such as provisions and depreciations. In addition, accounting profits are also affected by the accounting standards used and accounting policy applied. We have also said it normally applies, they should consider the time value of money. I think these are a concept which we did previously. It should consider the time value of money by discounting cash flows. It should use cash flows relating to the entire life of the projects when evaluating the project viability. The other thing that we are looking here is we are saying it should rank the projects according to true profitability, and that is why I've said, as much as we are going to be arguing over, we are going to be discussing more of this topic. It means that we are going to be ranking our projects using the profitability index. It should be consistent with the shareholders' main objective of maximization of the cash flows, and also minimization. And it means that when the cash flows are used and when such cash flows are discounted, we know that the discounting is whereby we look on the future, we bring to the current values. And it should be consistent with the value additivity principle, where the different projects can be combined to get the total increase in the value of the firm. And down there, we are looking at some of the things which we did under section 3, investment appraisal techniques. You can see there we have non-discounted cash flow techniques, which there before we used to call them traditional techniques. There are only two. We have the accounting rate of return, and then we have the payback period. I think the payback period is mostly tested. You can be able to check that with your past papers. Then we have the discounted cash flow techniques, which we are talking of the modern techniques. And we are saying here, we have the net present values, right? We have the internal rate of return. We have the profitability index. We have the discounted payback period, and then we have the modified internal rate of return. Without wasting a lot of time here, it is very important because all of these areas are already elaborated in our notes. I just want to go straight to the most important and powerful model, which we can be able to to test or to check on the profitability of the implementation of the proposed projects which you want to undertake as an organization. And in this case, allow me to just discuss the NPV, right? The net present value is most of the powerful models, and when the examiner is silent in an exam, by the way, when the examiner is silent, it is very crucial for you to use the net present values, the net present values. Now, when you look on what is a net present value, we are saying it is the difference between the present value of the cash inflows and the present value of the cash outflows, right? The inflows and the outflows, right? The inflows is the cash in, and then the outflows is what you're going to be spending. Now, the cash flows are basically, when you are computing the NPV, you normally use three categories, right? We normally use three categories. But before I take you through the categories and also showing you the most important areas of focus, allow me to look at what is important during the acceptance period of the NPV. We are saying when a project is basically positive, when your NPV is positive, it means that you have to accept that project. And when the project is negative, it means you have to be rejecting it. Then a project with a zero NPV may be accepted, but the one which is negative, we have to be rejecting it. The higher the NPV, the better the project it is. Now, when you look on the advantages which are pros, we are saying consider the time. It normally consider the time value of the money by discounting the cash flows. It basically uses the cash flows and not the accounting profits and not easily manipulated. It is consistent with the value addition principle NPV of the project and can be compiled together with together to get the total increase in the value of the farm. We also been told that it normally rank the projects based on the profitability. It uses the cash flows for the entire life of the projects, right? I normally see some people, they are saying that ubaya wake now, ubaya yako, ubaya ya mtu. Now, when you look on the problem regarding to the NPV, we are saying it is difficult to compute and apply when compared to traditional techniques, which we'll be able to revisit later. It can be affected by the assumptions involved in calculating the cost of capital, which is used as a discount factor. I think you will be able, you're able to get me loud and clear. Also, we are saying it assumes that all the projects of the farm are affected by the same level of risk. That is, all the projects are discounted using the same cost of capital. Then the other one, we are saying it may conflict with the internal rate of return when comparing the projects with different economic lives. And it may conflict with the internal rate of return when comparing the project with different initial phases. And it may conflict with the IRR when comparing project penetrating and conventional cash flows. Those are, I think, existing in your notes, and you can just be able to master 5 of them if the examiner tries to test you such kind of things. Now, I want just to take you through how do we normally compute the payback period. That is the most important thing, right? That is most important, the most important thing, the most important now. So allow me to take you through how do you normally compute the NPV. It normally takes only 3 stages. The NPV normally takes 3 stages. I think you are able to hear me or get me clear. In other terms, I'm audible enough. Right. So in this case here, you just need to tell me, right? We are doing advanced capital budgeting. Capital budgeting decisions. And these are the things that I know very well. You revisited them when you were doing section 3. These are the things, we are just revisiting what we did there before. Now, we have already started with the NPV. And I know that you're not, my board might not be clear. We see whether it can be better. Okay. So we have said we are looking on the investment appraisal. investment appraisal techniques. Investment appraisal techniques. And I have said it is very crucial if we are able to start with number one, which is our NPV. The NPV, we have said, it is the difference between the cash inflows minus the cash outflows. The cash outflow. That is what we have talked about, the NPV there. And in this case, I just want to take you the shortest part of it, right? I just want to take you on now the stages which you basically have to use when you are computing the NPV. One of it, number A, you have to be calculating something called the initial outlay. The initial outlay. In other terms, I will just be writing it in that manner. So how do you normally calculate the initial outlay? You are going to be having only two columns here. Something looking like that. So we are going to be, because in evaluating the projects, we might be looking on the replacements of the machines. We might be assessing whether we have to be undertaking a certain project. It might not be the machines. It means, let us look at the cost of machine or the cost of the project. The cost of the project stock machine. The cost of the project stock machine, we normally put it there. Then, for example, if you are dealing with a machine, it normally has some incidental cost we have to be adding here. Incidental. We normally have some incidental costs. And the incidental cost, we normally have things like, for example, installation costs. The installation cost we put there. We have import duty. The import duty we put here. We have things like freight charges. We have things like freight charges. Our freight charges, you put them here. Then we have commissioning. Commissioning cost. You put them there. Then you get your totals here. You put your totals here. Now, once you put your totals there, I need you to get something called the total cost of the machine. Those are the total cost of the machine. We put them here. The total cost of the machine we put there. And if, for example, you are replacing a machine, there is another steps which you have to be following here. For example, we are going, we are replacing an existing machine. It means we have to be disposing. So we normally look on the disposal value of old machine. For example, as the technology advances, as the technology continue advancing, you might buy a machine. Within 3 to 4 years, the machine now is outdated. You just need to upgrade it, and you have to purchase another advanced machine. But it doesn't mean that the old machine it doesn't have a resale value, no. It means that you can be able to dispose and be used for other purposes. Now, after you take the disposal value of the old machine, we normally have to incorporate the tax on gain. The tax on gain, stock loss on disposal, right? You have to calculate the tax on gain, stock loss on disposal. And now we have to be checking the disposal value. The disposal value of old machine. The disposal value of the old machine, you put it there. Then we are going to be deducting something here. The net book value of old machine. The net book value of the old machine, we are going to be putting it here, we deduct. Then at the end of the day, you are going to be getting something here, which you normally call it the tax on gain. The tax on gain, stock loss on disposal. Right? How is it going to be becoming a tax? It means once you get your tax, No, once you get your gain or loss on disposal, you're going to be multiplying it with tax rates. We are going to be multiplying it with a tax rate. It might be 25%, it might be the tax rate, right? To get there. If it is positive, you add. If it is negative, something looking like that, right? Then what you're going to be getting down here, I think you are getting me clear. It is normally called the net cost. The new cost, it should be the net cost of the machine. The net cost of the machine, we get it here. Right? The net cost of the machine, we put it there. Then we normally add investment in working capital. The investment in working capital, it means if it is not computed, it is not given in a question, you just need to take your current asset minus current liabilities. You put it there. Right? Then what you're going to be getting down here is what we are calling it our initial outlay. Right? Our initial outlay now will be equal to that amount. That is how now you're going to be getting your initial outlay. Number two here, we normally calculate the annual net cash flows. The annual net cash flows. And when you're discussing about the annual net cash flows, you have to remember two things here, right? The annual net cash flows, we have to be checking on how your cash flows are given in a question. How is your cash flows given in a question? Remember, we have two things which we learned under financial management. We have things like...
Mwalimu.
Yes.
Kindly, before you proceed, at the very tail end, we are adding investment in?
Investment in working capital, WC.
Working capital, all right.
Yes,
then in brackets?
Working capital. Thank you for that clarity.
All right.
Now, because I'm moving up to this point, we have to be looking on the two things here. When we are looking on the time value of money, we talked about the determination of the future cash flows through the compounding and discounting, right? Now, when we look on the discounting, let me talk about the compounding. We normally look on the compounding of lump sum and for the annuities aspects. Now, when you look on the annuity, for example, is when we are going to be discussing of, for example, for the people who are investing on securities. And every year, for example, the principal amount of years is 100,000, right? The interest rate which they are giving you, for example, is 5%. 5% there. It means now, every year, for example, this investment of mine is for 10 years. So it means, and the interest rate is not changing. Now it means every year I'm going to be receiving 5,000 shillings, if that is the case of the argument. This is the annuity for the 10 years, right? This is the annuity for the 10 years. Now, what comes to the lump sum? The lump sum, it means, for the guys who normally say, I don't want to receive the 5,000, always take it back and reinvest. So if year one, this person has already 100,000 got 5,000, it means year two, you might be getting around 5250, continuing like that. This mode now of payment, whereby you're going to be receiving different types of payments in certain intervals. It means this is what we call a lump sum. The first year you receive 5,000, year two you receive 5250, and so on and so forth. So you have to be checking on your cash flows, and now the examiners given them. There must be a small challenge there. So I was saying, if, for example, you are able to get this kind of cash flows, 5,000, 5250, The other year, for example, you receive 5,300, you receive 50, the cash flows which are not the same, that is normally called lump sum. That is normally called lump sum. But under my formula here, I want to use for the annuity. For the annuity. For example, we are having year 1 to year 5 years. Year 1 to year 5 years. This is annuity. When you see things like this, that is annuity. That is annuity. Now, if it looks like that in our case here, and the examiner has not given you the same cash flows, we can state with ourselves. You put yourselves there, right? We put ourselves there. We less our variable costs. Variable costs. We put them here. What are we getting here? We are getting our gross profit. We are getting our gross profit there. Then after you get your profit or the gross profit, which you can also be able to call it the contribution, you can just be able to deduct what? You deduct your fixed costs. When you deduct your fixed costs, right? What you are getting that is normally called the earnings before or the profit before depreciation and taxes. The earnings or the profit before depreciation and taxes. We are getting it here. Right? The earnings before depreciation and taxes. The shortcut here, we can less our tax rate or taxes, less our tax. Right? We less our tax. We less our tax there. Right? Then this is the shortest one. The very best. We less our tax first. Then we add something we normally called depreciation tax shields. You will be able to see me writing DTS, depreciation tax shield. How do we normally get the depreciation tax shield? We say the depreciation tax shield is basically we normally take the costs minus, we normally take the costs minus the scrap value. We divide it by the number of years, and all of these we multiply by tax rate. The tax rate, you get that value there. You get this value there. The tax rate and so on, you get it there. Once you get it, right? Once you get that, what you are going to be getting down here is normally called the annual net cash flows. These are the shortest. And nobody will penalize you for using this method. Nobody will penalize you for using a shortcut in this. There is the other one which is very long. That we normally deduct the depreciation, deduct our taxes, then we add back depreciation. Even the ref. And if you can be able to do with both, you're going to be getting the same answer. You're going to be getting the same answer there. Sawa. Then the third and the last one, right? We normally want to calculate the terminal cash flows. The terminal cash flows. How do we normally get our terminal cash flows? How do we normally get our terminal cash flows? We normally take what? We normally take the scrap value of the new machine. The scrap value of the new machine. The scrap value of the new machine we put there. Then we less the scrap value of old machine. Right? If it is provided, then we add investment in working capital. And what the difference you are going to be getting there, it is the difference which you are going to be getting there is what we normally call the terminal cash flows. The terminal cash flows. The terminal cash flows. That is how you basically have to get your computations of the NPV. The first thing that you have to be following, it is the 3 steps. It is not a must that the examiner has to ask you to start from the sales, no. It is not a must to start from the cells. It's not a must to start from the cells. We will be able to check on the questions. Allow me to do a very simple. I just want to introduce. Today we are doing the introduction. We don't need to read much, but allow me to do some introductory part of it. So for those who they don't have a past paper, I said it is very important for you to download my Loft app. My Loft app, right? To access your past papers. Right? To access the past papers. I don't have rights for the app, but I know that it is the most efficient one to view the CASNEB past papers. So let me access mine. Let me access my past papers. Let me see whether I can get mine. Okay. As you try yours, so I'm trying to access mine. There are those students who are asking me, how, Mwalimu, can you be able to do this? Me, I normally do this. This is what I do. So very simple. I click there, right? It pops in. Then mine, it comes direct. Huh? I will use a different machine where it is not automated, so that I show you the steps. Now, we are looking for the CPA past papers. Let me go home. Okay. So once you go to the e-resources, you go to the CASNEB past papers, we talk about the CPA, right? So once you check there, you can come here and we look at the advanced financial management. The financial management there. It's here, and you just search it. Just need to search it. So I just want to do some a certain question here. It might be during our time when we were in class. Just want to start from that far. Then we shall continue building up. So it was tested on November. Let me start from here. November 2017. I say it is not a tedious process. November 2017. So November 2017 here, we are looking at question number 1B. Question number 1B. Someone to read for us, please. Someone to read, please. Someone to read. Very quickly.
They can read.
Okay, go on.
Rwanda Limited is considering purchasing a machine at a cost of 40 million shillings. The company will incur an additional 20 million shillings to modify the machine for special use. The machine is expected to have a useful life of 3 years and a scrap value of 15 million after 3 years. This investment will require an increase in net working capital of 2 million shillings at the beginning of its useful life. The additional investment in working capital will return to normal at the end of the machine's useful life. The machine's purchase will not affect revenues, but it is expected to save the company 25 million shillings each year in before tax operating costs, mainly labor. The corporation tax rate is 30%, and the company cost of capital is 10%. Required advise Viwanda Limited on whether to buy the machine. Number 2, suppose the firm's management is unsure about the saving in before tax operating costs, carry out a sensitivity analysis on this variable, assuming that the variable shall vary adversely by 10%.
Now, on the requirement part 2, we shall revisit later. But allow me to do part 1. And that is why I said, if the examiner has not given you the method for the investment appraisal technique which you're supposed to be using, you don't need to panic. If they have not given you, then use the NPV, right? If they have not given you, use the NPV. You can see there, they have not told you to use the NPV, but they have told you to advise. Use NPV to advise. Now, let us follow our 3 steps to get our question right. So let me share my board. I think you have opened from your end. So in my case here, okay, so we can proceed. Now, because I know that the stages for the NPV, number 1, we are talking about the initial outlay. The initial outlay there. The initial outlay, right? Now, the initial outlay, I just need to have 2 columns here. Kenya shillings and Kenya shillings here. Correct? So I will start from where the question, where I will start reading my question again. Viwanda Limited is considering purchasing a machine at a cost. So the cost of the machine is how much? The cost of the machine is 40 million. In our case here, let me put my zeros in this case. So this is 40,000. That is 40,000 there. Then we are being told, as you move on, the company will incur an additional 20 million to modify. So in this case, the incidental cost of ours, it is modification. Modification costs. So the modification cost of ours is 20,000 here. Right? I have not heard of anything else which we have to be putting in there. So in this case, it means the new cost of the machine, right? The total cost of the new machine should be how much? The total cost of the new machine should be around 60,000. Should be 60,000 there. Then we are being told the machine is expected to have a useful life of 3 years and scrap value of 15 million after 3 years. And then we are being told this investment will require an increase in net working capital of 2 million at the beginning of its useful life, right? As our question on how it's drafted, you can see there is no any that part of the replacement of the machine, right? If it is not there, don't continue putting the format here. Just go straight to say, can we be able to add, right, investment in working capital? The investment in our working capital is 2,000. In this case, it means our initial outlay should be 62,000. At ukiangalia, I have not used a calculator. Number 2 now, we need to get the net annual net cash flows. The annual net cash flows. The annual net cash flows. The annual net cash flows. Now, the annual net cash flows, we will be able to start with what? We have to be looking on how the question is being set. Is it a lump sum question or is it an annuity? Now, in this case, what will be directing us? It is the note is the second last paragraph where we've been told the machines. Right, we are being told there, the machine's purchase will not affect the revenues, but it is expected to save. I know today when you go to the market and you are purchasing, for example, you are purchasing a shirt, you end a budget of 1,500 and then you get a shirt of 1,000. It means the 500 becomes a saving, is an income to you. So in this case, it means each year, right? Each year we are going to be saving a whopping of 25 million. Right? So in this case, we are talking about the annual savings. Annual savings pre-tax. Right? It is normally called the annual savings pre-tax costs. The pre-tax costs. In other terms, you can call it the earning before depreciation and tax. The earning before depreciation and tax. In our case here, we are being given 25,000. You are being given 25,000 there. Because here we are talking about earning before depreciation and tax. We say, can we be able to raise our taxes at the rate of, as our examiner given us the corporation tax rate, yes, at the rate of 30%. 30%. That percent of this is around 7,500, right? Then we say, can we be able to add the depreciation tax sheet? Depreciation tax sheet. We say, can we be able to take the costs? Now, the cost of this machine is not 40. The total cost is there. The cost plus the incidental. The cost plus the incidental of ours is 60,000. Minus, have we told that the machine will be having a scrap value? Yes. I've been told that the machine is expected to have a useful life of 3 years and a scrap value of 15,000. You divide these by the useful life of the project, which you are being given as 3 years. 3 years. And all of these you multiply by tax rate of 30%. Tax rate of 30%. So how much is this? How much is this? How much is this? Someone to take the calculator and compute on our behalf. How much is this? 45 divided by 3, we are getting around 15 times 30. How much is that? We're getting around 4,500. What is your annual net cash flows? The annual net cash flows I can see is around 22,000. The annual net cash flows is around 22,000 here. Then number 3 here, we said, can we be able to calculate something called the terminal cash flows? The terminal cash flows, very simple, right? The terminal cash flows. The terminal cash flows, it means it is another source for the income to the organization. Now, the terminal cash flows, it means that you have, for example, you might be disposing the project at the end, not the project, but the machine at the end of the useful life. So we said here, can we take the scrap value of the new machine, the scrap value of the new machine, which is around 15,000, which is 15,000 there. Then we less the scrap value of old machine in case of replacement. We shall be able to do question regarding that. Then we add investment in working capital. Our investment in working capital is 2,000. Is 2,000. This gets around 17,000 there. 17,000. It doesn't mean that you are done with the computations for the NPV. Those are the 3 stages which you have to follow. Once you follow that, you need to discount your cash flows. So in this case, it means you have to be taking the number of years. For example, our project now takes from year 1 to year 3, 1 to 3 years, because an annuity. This is how I have to be writing it, right? Then here we are going to be having our cash flows. We have our discount factor, at which rate? It is already provided there as part of the cost of capital, which is 10%. Then we get our present value at the end there. So under year 3, we have different incomes. There is this one which you are going to be getting for year 1, year 2, year 3. This is an annuity, 22,000 there. Then at year 3, at the completion of our project, we are also going to be disposing this. We are going to be terminating and getting 17 million again, right? Now, I normally like to use 2 things here. The formulas. Some of the students normally prefer to use the table. But Mimi, I like to use the formulas. The formula for annuity, remember, you used to take 1 minus 1 plus r, you raise power negative n divided by r, then the one for the lump sum. You used to take 1 plus r, you raise power negative what? You raise power negative n. So in our case here, remember your rate is your discount factor, which is our r is discount factor, which is 10. So in this case, in my bracket here, I have 1.1. You raise it to power negative 5. Oh, sorry, negative n. Our negative n is our third year. Negative 3, right? Then we say 1 minus my answer. 1 minus my answer. We divide it by our rate, which is 0.1. We are getting something closer to 2.4869. You can see that is what you are getting under the annuity. Even if you are using a table, you'll be able to get this. Now, on the side of the lump sum, right, we just need to take 1.1. 1.1, we raise for negative 3. We are getting 0.7513. 0.7513. Then at the end, to get your present value, you just need to take your cash flows and multiply by the discount factors. So 22,000 times 2.4869, getting around 54,712. 54,712. 54,712. Then the other one will be 17,000. We multiply by 0.7513, getting around 12,772. Do your summation. What you're going to be getting there, it is normally called the present value of the cash inflows. Right? It is normally called the present value of the cash inflows. The present value of the cash inflows. The present value of the cash inflows. It is the summation between the two. So plus 54,712. Getting 67,484. Then you less your initial outlay. You less your initial outlay, which we said it is 62, right? Less your initial outlay here, which is 62,000. What are you getting here is your NPV. So my NPV would be 5484. 5484. 5484. So what should I advise Viwanda Limited? Advise here. We said under the advice, if the NPV is positive, you have to accept. If it is negative, you reject, and so on and so forth. So in this case, we say Viwanda Limited should accept or should buy the machine. The Viwanda Limited should be able to buy that machine, should be able to buy the machine, should be able to buy the machine. That is the most easy way of computing the NPV. Any question? Any question? Any question? Any question? Any question there?
Yes, Mwalimu.
Yes, yes.
When computing the annuity,
Yes.
what are you replacing R with?
Our R here, the R is our 10%, which is our discount factor, the cost of capital.
And the N?
N is the number of years. 3 years.
Okay.
Yes. Now from there, I have to introduce you to something different here. As per our notes, I'm just doing introductory for better understanding of the topic. There is another modern technique, which is normally called the internal rate of return. And under the internal rate of return, we have said it is the discount factor at which the NPV equals to 0. At which the NPV equals to 0. And we are saying the discount factor that equates the present value of the cash flows to the initial outlay. In simple terms here, we can say it is the break-even point, or it is the break-even cost of capital. It is normally where you normally find that the present value of the cash inflows is equal to the initial outlay. Now, it is just like a break-even. So in the first, what am I supposed to be doing here? The first step is to calculate the project's NPV. If the NPV is positive, it means the cost of capital is lower, right, than the internal rate of return. We therefore increase the cost of capital using the trial and error method, and we calculate the NPV, aiming to generate a negative stroke 0 NPV. The opposite would apply if the NPV was positive, right? Now, in our case here, remember we were using 10%. And in our 10%, we got our NPV as 5484, which is positive. So what are we going to do? In order to calculate our IRR, we need to get a negative NPV. So what should we do? We are going to be using a trial and error experiment. And that is why during the marking, the IRR, it means every student should be getting his or her own internal rate of returns, right? The internal rate of returns. That is very important. So in that case, for example, if it was 10% and you got a positive NPV, it means you can increase it to 30, 25, 20, right? On a proportion that, or on a percentage that you know, you're going to be getting a negative NPV. For example, mine, I will be able to use, for example, 25. The formula for the computation, we then interpolate the rates between the two NPVs, the positive and negative, using the formula. When you look on the formula here, we normally take the lower rate plus the NPV of the lower rates. You divide it by the differences in the NPVs. Then we take the higher minus the lower in a different bracket. Now, how do we normally do this? We are saying a comparison is basically made between the project's internal rate of return and the cost of capital. A project whose IRR is higher than the cost of capital is accepted, right? Whose IRR is more than the cost of capital is going to be accepted. Sometimes the examiner might be telling you to use the IRR of that amount, right? Sorry, to advise using IRR, and we have said you have to be factoring those things. Then we are saying that is accepted, such projects will have a positive NPV and its profitability index will be greater than 1. Okay. Will be greater than 1. So a project whose IRR is less than the cost of capital, we are saying, is going to be rejected if NPV is negative and PI is less than 1. So it means if you get the NPV positive, it means that you are going to be getting IRR, which is greater than the cost of capital, right? That is the case, and the PI should be greater than 1. So a project whose IRR equal to cost of the capital may be accepted if NPV is 0 and the PI equals to 1. So for the rankings purposes, the higher the IRR, the better the projects. The advantages, the disadvantages, you can refer to the other ones which we have learned there before. So let me just use this illustration which you are doing here. Let us use our illustration here to do our. Let us use this illustration. I just need this part because I've said under the internal rate of return, I'm just going to be changing here. I'm going just to be changing here. So if this is 10 and is giving me 50.4, I'm going to be increasing it maybe 25%, right? Using the trial and error experiment to 24% or 25. Then I will be able to see whether I can be able to get a positive or a negative NPV. But if this was negative, it means the rate now you have to reduce. You can go to 1% to get a positive. That is the case. That is what we said about the vice versa. So if the examiner is telling you to calculate, never forget the formula. Let me use the same formula here. It's very simple. Very, very simple. So if this applies, the NPV, you can be able to see it there. So we are having our cash flows, right? We talked about the number of years. So we are going to be starting with the years, cash flows, right? We have the discount factor. And in this case, I have said, I'm going to be using a try and error for myself. Will be around 25%. We get our present values there. So we have this IRR now. So we have year 1 to 3 years. The cash flows we got is 22,000 and year 3 was 17,000. Year 3 was 17,000 there. So in this case, it means, I just need to use the formulas. For the annuity, we have used our formula here. So once you take your calculator, we say our rate now becomes 25. So it will be 1 plus 0.25. We raise it to power negative 3. 1 minus answer divided by 0.25. Right? We are getting 1 point. Even if you go to the table, this is what you're going to be getting. Now, the other one will be for 17, it will be 1.25. We raised to power negative 3, getting around 0. Hello? Someone is talking? Someone might be rating me. Someone wants to say something? If there is no one who is saying something, let me proceed with the analysis. So that is how you remember where you left. I remember some of you were able to say, I have done with section 3. Not yet done. You are not yet done. Okay, let us proceed. So once you get your discount factors in this manner, now, can we be able to get the present values? Is it possible we get our present values? I don't know why the machine is misbehaving. Sorry for that. Now, let us get our present values here. So the present value can be able to get it by taking what? 22,000. We multiply by 1.9520. We are getting around 42,000, 42,944. Then we have year 3, where you can be able to take 17,000, multiply by 0.5120, getting around 8704. Get the present value of the cash inflow. The present value of the cash inflow, it will be plus 42,944, getting 51,648. Then you less your initial outlay, which is 62,000. What is your NPV here? We say our NPV minus 62,000 will be 10,352 negative, right? Now, once you get that, never forget the formula. We say to get the internal rate of return, you take the lower rate. You take the NPV of the lower rate. We divide it by the differences in NPVs. Then we take the higher rate minus the lower rate. Now, how much was the lower rate? The lower rate was 10%. So we say 10 plus what? The NPV of the lower rate, which is 5484. Then you divide it by the differences. We normally take the positive minus the negative. So in this case, it will be 5484 minus 10352. 10352. Then you close these brackets. Then you take the higher rate, which was 25 minus 10. 25 minus 10. So how much is this? So it will be 5484 plus, this become positive 10352. Then you take 5484, you divide by answer, then you multiply by, this difference is 10, is 15, sorry, times 15. Then you add 10. So this you get around 15.20%.
I have a question, Mwalimu.
Yes.
Why have you taken the 5484 minus 10352 and not the other way around?
No, I have said based on the criteria of the formula, you normally take the positive value. Even if now this was negative,
All right.
from the initial, this was negative now. And this, which we are calculating here, become the positive. You take the positive minus the negative.
Okay,
But not
thank
the
you.
other way around. You're going to be getting your own things. And that is not what the formula entails. Is it okay?
Yes, it is.
Okay. Now, once you understand that, now, you can now go to the acceptance criteria. We said when the IRR is greater than the cost of capital, which was initially given, you need to accept that project. You can see this 15.20, and the cost of capital of yours was 10%. Then you need to accept. Then it means if the IRR is greater than the cost of capital, it means also the NPV should be positive. The NPV should be positive. And that is what we talked about. That is what the notes are talking about. Those are the very simple things which you need to know. When you look at still on the same formulas now, because I don't want to stay here for much longer, there is a concept here related to the there is another thing here. These all are now the advanced techniques. That one is done. There are. I know there is a question which was tested recently related to all of this, and we will be able to revisit it. But first, we are just introducing the topic. Now, we have the profitability index, and we are saying it is the ratio that compares the present value of the cash inflows with the initial trade. So how do we normally calculate the PI, which is the profitability index? We normally take the present value of the cash inflows, we divide by the initial trade. Acceptance rule here, we are saying that a project whose PI is greater than 1 is accepted, while a project whose PI is less than 1 is rejected. The project whose PI is equal to 1 may be accepted. Then we are saying that for the ranking purposes, the higher the PI, the better. For advantages and demerits, refer to NPV. And PI applied in a situation of capital rationing, limitation whose projects are ranked for optimization of the limited available resources for investment purposes. Now, that being said and done now, from our question which we are doing here, examiner now wants you to calculate your PI here, right? Examiner wants you to calculate the PI, the profitability index. You tell that examiner, can I be able to take the present value of the cash inflows, you divide it by our initial trade. And in our case, remember this was our original question. This one we have just crafted it because you are doing the internal rate of return. Just leave this. So the initial, when you look at the present value of the cash inflow, right, was around 67,484. You divide it by, what was your initial outlay? We said our initial outlay was around 62,000. So how much is your PI? How much was your PI? So that is how easy these things are. So 67,484, you divide by 62,000. We are getting around 1. It should be 1.1. Let me put it like this. 1.1, 1.1, 1.1, 1.1. And we are saying if the PI is greater than cost of capital, the project is is good and vice versa. That is the case. If you accept a project under NPV, you also accept, sorry. If there is a challenge there with the network. We have said, if you accept a project under the NPV, you also accept it under the IRR and PI, and vice versa. Now, there is another thing there which we have discussed about the advanced, which we are calling it the discounted. It's normally called the discounted payback period, but I cannot be able to do it. I have to teach you about the payback period. Then we come to do the discounted payback period. Then I think that one will be done. So let me do a different question with a different setup. Then we see where we can reach. I just need to do one more example. Then the questions are kitambo zinaisha. We are going now to be moving to the recent questions. So in this case for today, I just want to do a question here. There is a question, very good, tested here on, let me see whether I can get it. Not during this period, sorry. I don't know whether I'll be able to find it. Okay. Should be here. It was a pilot paper during our days. So it was question number 4. Someone reads the Omena Limited. Someone read this.
I'll read it.
Okay.
Omena Limited is a firm in the manufacturing industry. The management of this company are considering purchasing a new machine at a cost of shillings 125 million. This investment is expected to reduce manufacturing costs by 45 million annually. The firm will need to increase its net operating working capital by 12.5 million when the machine is installed, but the required operating working capital will return to the original level when the machine is sold after 5 years. Omena Limited will use the straight line method to depreciate the machine and it expects to sell the machine at the end of 5 years operating life for 11.50 million. The company pays corporate taxes at a rate of 30% and uses 10% cost of capital to evaluate projects of this nature. Required. A, the project net present value.
Thank you. That is what we require. Don't go beyond that. The net present value. I hope I'm not breaking. The project's net present value, right? Only 3 marks. So examiner requires you to do this question less than 5 minutes. So we have been told that the management of this company are considering purchasing a new machine. The cost is 125 million Kenya shillings. We have been told that this investment is expected to reduce the manufacturing cost by 45 million annually. So you can see that is the earnings before depreciation and taxes. Everything that we are saving is our income. So the firm will need to increase its net operating working capital by 12.5 million. Right, I know you know what is that. Then we have been told there, but the required operating working capital will return to the original level when the machine is sold after 5 years. But you're being told down there, Omena Limited will use a straight line method to depreciate the machines, and it is expected to sell the machine at the end of the 5 years, operating life for 11.5 million. So the company pays corporation tax of 30 and the cost is 10%. The cost of capital is 10%. Very simple question here. 3 steps followed for the NPV. 3 steps followed here. Number 1, let us look at the initial outlay. The initial outlay here. Let me have our Kenya shillings there, reduced to thousands. So we are going to be starting with the cost of the machine. The cost of the machine we are being told is 125,000. Remember, we normally add incidental costs. In our case here, we are being told there is none. So the total cost of the new machine is how much? The total cost of the new machine, we are being told now, will remain at 125,000. Now, let us add, because I have not add of replacement, add the investment in working capital. The investment in working capital, we are being told is how much? The investment in working capital, they talked about 12.5 million. In our case, should be 12,500. What is the initial outlay? Right? It will be 137,500. Correct? That is my initial outlay. Number 2, we are talking about the annual net cash flows. The annual net cash flows, and we are looking on the annuity aspects because there's part of the question that is what they are talking about. So we are being told, right, they are going to be saving 25 million in a year. Not 25 rather, but 45 million. So the earning before depreciation and taxes is 45,000. You less your taxes. I was able to see the tax was at the rate of 30%. So 30% of this is how much? The 30% of it is around 13,500. Then we look at, we add the depreciation tax shield. What is the cost of the machine? 125,000 minus the scrap value. They were saying that they are going to be disposing this machine at 11,500 after the end of how many years? 5 years. Then you multiply by the tax rate of 30%. The tax rate of 30%. So how much it is? Just say 125,000 minus 11,500 divide by 5, right? You multiply by 0.3, getting around 6,810. What is your initial outlay? What is your annual net cash flow? Sorry. The annual net cash flows of yours would be 45,000 minus 13,500 plus my answer. Sorry. Plus my answer plus my 6,810 now. We are getting 30,310. Step number 3 and the last one, we are talking about the terminal cash flows. The terminal cash flows in thousands of shillings. So let us take the scrap value of the new machine. We were being told that the scrap value of the new machine was around 11,500. I think that is what we were able to put here. Then we less the scrap value of old machine, which is dash. Then we add investment in working capital. The investment in working capital, we were being told was 12,500. You can see Newton, I'm not struggling now. So the terminal cash flow of yours would be how much? 11,500 plus 12,500, getting around 24,000. You go very quickly and you calculate here the present value of the cash inflows by taking your years we are talking about 1 to 5 years. And then year 5, you will be able to receive another cash flow. So you take your cash flows, correct? So year 1 to 5, you're going to be receiving 30,310. Then year 5, you're going to be receiving 24,000. The discount factor, we are being told, is at the rate of 10%. Then you get your present value there. The annuities, we said we take 1 minus 1 plus R raised to negative N, you divide by R, right? Now, what is your rate? 10%. Now, in this case, I just say 1.1 I raised to negative 5. 1 minus answer, you divide by your rate of 0.1, getting 3.7908. The other one will be how much? 1.1 you raised for negative 5 now, which is lump sum. We get 0.6209. To be able to understand the concept of the lump sum, the annuities. Sorry for the Kadis numbers, their network. So even if you want to understand all of these, it is very important for you to repeat. So in this case, it will be 3310. We multiply it with 3.7908, getting around 145, 226. Then the other one is 24,000 times 0.6209, getting 14,902. So what is your present value of the cash inflow? The present value of your cash inflow, 145, 226. We get around 160, 128. Then you less your initial outlay of 137, 500. 137, 500. So what is your NPV here? So we say our NPV would be minus 137, 500, 22,628. So our device here. So the advice which we can be able to give out there. The advice which you can give out. What was the question first? The question was asking us the project's net present value. The project's net present value. And that is the answer for the question. That is the answer for the question. Now, because I know now you are getting some of the interesting things here. I just want tomorrow, once we meet, then there is a question you can ask. Don't want to leave anything untouched. So I think I'm not breaking. So techniques of early risk is what we are going to be looking at it tomorrow. So number one, and it is not a must they follow the way I'm putting them here. So the number one will be the decision theory. I know that you have come across some of the techniques which we shall be listing down. Decision theory. Number two, we talk about simulation analysis. Simulation analysis. Number three, we are discussing about sensitivity analysis. Sensitivity analysis. We talk about number four, which is scenario. Scenario analysis, right? Number five, we can talk about the risk adjusted. Risk adjusted discounted rates. Risk adjusted discounted rates. Number 6, we can talk about certainty, equivalent, coefficient. We have started the exam now. Number 7, we talk about utility analysis. Utility analysis. These are the most key things which we have to be checking on, 1 or 2. We will not be able to finish all of them in one session for better understanding. So we'll just be going bit by bit, maybe 2 in 1 class, 2, 2, 2. We see whether we can be able to finalize with them. Because you need to understand them for better tackling of the exams. You can do your analysis. You'll be able to find that we cannot go 1 or 2 semesters or sittings without having one of the techniques tested in the exams. One of the techniques be tested in those exams. So allow me to stop at that point so that we can run to finalize on the filing the returns. So let us continue looking for money for the government. Any questions?